Hello, I'm Paul Orchowski. Welcome to MGO's November 2021 market update. Leading our discussion today will be Michael Moskal, MGO's Director of Investments, and also joining in is Scott Lipa, MGO's Senior Investment Advisor. So with that, we will turn it over to Michael.
Well, thank you, Paul. And hi again, everybody. Well, we're headed down the home stretch of 2021, and it's been a great year. You know, for certain segments of the market, like the stock market, it's been a great time for the stock market this year, and not so great for the bond market. And there's other areas of the market that have done well also. So let's take a look at the scorecard for the year. And you can see why the stock market, we talked about, it's a good year so far. It's been a great year for most areas. It's really been a US driven rally this year. And those first three stock indexes that you see there are mainly US driven. The all country index is about 65% US. And of course, the Dow Jones and the S&P are US indexes themselves. Interesting, if you take the US out of the equation, if you look at the rest of the world without the US, we're up 7.4% instead of the 17 to 23%. So a big difference this year. Again, the US driving really stock returns. Bond market, as we mentioned, has been negative this year. Why? Because rates have gone up, interest rates have gone up this year. We started the year off at the 10-year Treasury, a little bit under 1%. We're at about 1.5% right now. So as rates go up, bond prices go down, and that's what we've had this year. You know, rates going down helps bond prices, but this year for high quality bonds, we've seen some negative numbers. Other areas of the market, oil is just the opposite story this year as it was last year. You know, last year in 2020 was down 23%. And if we remember back to April, you guys, we actually had a negative day where oil prices were negative in April last year. And so we've come a long way. Oil prices are about $82 a barrel. So we've come a long way up, back up. And a lot of that has to do with inflation and some of the supply shortages going on. Surprisingly, this year, gold is down. You know, gold usually historically has been performed well when you have periods of higher inflation. We've not seen that this year. We did see it last year, you know, so for the last couple of years, if you take the last couple of years combined, gold's up 24%. But, you know, there's been talk, of course, with some that Bitcoin is like the new gold. And we certainly have seen Bitcoin and other cryptocurrencies do well this year. So we'll see if that bears out in the future. And then for the typical investor, you know, the average investor, and we're looking at the average investor, you know, the average age maybe a mid-50s here. When you combine younger investors at 25 and older investors in their 70s or 80s, you know, the typical investor here is up about 9%. If you project it out for the year, this would be really the third year in a row that the you know, average and traditional investor would be up double digits for a year, which is really good. Our bigger discussion today is going to be on inflation. You know, I think we're all feeling inflation. If we go to the grocery store, you know, if we go to the gas pump, you know, whatever we're doing, if we have a business, we're ordering supplies. You know, we've kind of heard it across the board, you guys, with our customer base, no matter what business that they're in, that they're feeling a little bit of a pinch of inflation. You know, I went to the store the other day to buy a dozen eggs. It was $1.80 for a dozen eggs, and you know, I'd written down it was $1.40 last year. So we've seen some increases in just about everything. Just as a precursor to inflation, you know, we like to look back and say, you know, what is the motivation here? You know, what's the government, the Federal Reserve? You know, the Fed has a lot to do with inflation. So what's the precursor? You know, what do they want? What are they looking for? You know, and Jay Powell said earlier this year that they wanted inflation to be higher. And, you know, I think if you look at what they want, they would like interest rates to stay low and inflation to be high. You know, why? Because low interest rates encourages more borrowing. And the more borrowing that goes out there and the more spending, you know, for us to go out and borrow money or businesses to borrow and spend, our economy is about 75% of us spending money on things. So, you know, Congress's motivation, the government's motivation, the Fed's motivation is for us to spend more money. You know, and how do we do that? By going out and borrowing it at low rates and spending it on houses and other kind of things. So that's one of the motivations. You know, why do they want inflation higher? Well, one reason they would want inflation higher is because I think all of us know that the debt in this country keeps getting higher and higher. You know, right now, Congress is sort of embroiled in this fighting over infrastructure. The the House just passed $1 trillion. That's going to be all borrowed money. And you combine that with the pandemic borrowing, you're talking about $3.5 trillion or so of borrowed money. They got to pay interest on that money. And the higher inflation goes. So for one, the lower the rates are, the lower the cost of the debt payback is. And then higher inflation means $1 borrowed today. If inflation's at 3%, it may cost 70 cents to pay it back 10 years from now. So there's sort of a motivation going on there from the government and the Fed's perspective on why they're doing what they're doing. The Fed originally said it wanted 2% inflation, guys. We know it's not 2%. The latest print actually today, I think they came out with producer price index was an 8.6% increase in producer prices over the last year. So, at first the Fed thought that this was transitory, which just means temporary. I think they've sort of relented, Scott and Paul, on that a little bit.
Yeah, I get frustrated when I hear the term transitory over and over again, because once you condition consumers to pay more for a good or service, rarely does it go back below the price that it originally was, call it pre-COVID. So maybe a little bit of it's transitory, but a lot of it is conditioning us to pay more for goods and services. So I'm not sure how transitory this really is. And I'm concerned too that you get to, you're mentioning 8% inflation now. If this supply chain bottleneck continues the way it is and store shelves are empty throughout the holiday season, it wouldn't surprise me to see double-digit inflation by next year.
Yeah, it very, very well can happen. Another point, Scott, along your lines, when you see wages and salaries, and I have up here on the screen the last line, wages and salaries up 4.6%. And I think, Paul, that was the highest print we've had in something like 15, 17 years.
Right.
I'm sorry, what?
You can't take away. So, once
exactly.
you start those wages, you're stuck with it. So
exactly. You're not gonna increase wages and then go back a year from now and say, I'm gonna cut you back by 10%. That just doesn't. I think there's only one time in our careers we've seen that, and that was during the financial crisis. We may have seen a little bit of that. Mm-hmm. But it would take something like that to happen. But generally speaking, when you raise people's wages and salaries, they're not going back. Which plays to your thing, Scott, about once you have that mindset, people are going to start getting used to paying for higher prices for things, but they're also getting used to they need higher wages to pay for it.
But the concerning part is the wage. You have 4.6% is what it's up year over year, but inflation, we're talking 7, 8, 9%. So even though people are making more and may feel wealthier, they're still not able to keep pace with the price of goods over the last 6 months or so.
And that's inflation, and those of us who've been around long enough to remember the 70s and 80s, we had a 13, I think the highest it got, Paul, in 1980 was 13.4%. Mm-hmm. I was in high school and I think you were maybe in college at that point, but right. It was 13.4% inflation, Scott. So, those are painful numbers when you start talking about that. How does this affect investments? Are your investments as a client? We already started reacting to this. Probably, I'm going to say it was a year ago, guys. Right? Yep. We started seeing this happening, and we started investing more in those areas of the economy that would benefit from more embedded inflation. Companies that could have more pricing power, which just means they can raise their prices, and people still are going to buy their products. So you're looking at things like energy. We're still going to put gasoline in our cars, even if gas is up. Now, maybe if gas goes to $10 a gallon, we wouldn't. But certainly when gas is up 50 cents, 70 cents, $1 a gallon, we're going to do it. Consumer staples. I have the picture on here of different products from Procter & Gamble. We're going to buy detergent. We're going to buy toilet paper. We're going to buy paper towels and razors. We're still going to do that, even if it's 20% higher the prices. We're still going to do it because we need it. We still need it. Utilities. I'm still flipping the lights on here. I'm still going to turn the lights on and those kind of things. So even if the prices are a little bit higher. And materials has a lot to do with building. We'll talk about infrastructure in a minute, but certainly with housing, these are all type of things. And the picture on here is of materials. So brick, cement, concrete, Sherwin-Williams, the company I name here, is a paint company, but that's right in line with this, that material prices have significantly gone up and we're still buying these materials. So they can increase their prices and we're still going to be buying these type of materials.
Well, what's interesting about this too is from a macro standpoint, these areas that you have in here, energy and utilities specifically, didn't perform real well last year. I mean, they were kind of the laggards of the market. And, when you think about what happened in 2020, all of 2020 was shelter in place and technology related and Amazon related, that's what did well. So when we were looking at this about this time last year, we're saying to ourselves, where can we find some value? And conversely, the timing of it seems good because these are some of the market leaders in 2021.
Yeah, absolutely. And right with that, Scott, is if, part of our research that we do for our clients, part of our research structure is looking at returns, what we think is going to be, hot and good in the next 10 years. We know what the past 10 years has been like. And if you look at 10-year returns on some of these areas, like you said, for even last year, but going back even farther, what we call the commodity area. So, a lot of these energy and materials certainly fall into what we call the commodity area, hard assets. And if you look back at the last 10 years, we actually have the commodity area with negative returns, on average for 10 years, and you're looking at that versus, say, the US stock market, which has been up 16% a year for the last 10 years. So there are cycles that happen, right? And so this next 10-year cycle, we may be looking at something different, where maybe general stock prices don't perform at 16% a year, but commodities are maybe the leader. So that also has something to do with this. All right, let's take we're going to take what we call market minute at these topics. These are areas that we've had clients asking about, more recently. And we're going to kind of weigh in on what we think about these areas and the future for the investments in these areas. So what do you guys think? Electric vehicles, EV stocks? What are your thoughts?
I think a lot of clients are asking about them. I think they're the wave of the future, but as we've discussed, is the infrastructure there to support everyone moving to electric vehicles over the next 10 years or so? It isn't currently, but I guess 1 and 2 kind of go together a little bit as far as electric vehicles need some sort of updated infrastructure if we're going to do that.
Yeah, I mean, absolutely. I've talked to a few clients where I say, I look out my window and I don't see a lot of EV cars driving around up and down my street here. We're still a fossil fuel society. It's going to take a while. I think all of us would agree that EV or some kind of alternative energy sources, are going to become more prevalent in the future. We're just not there yet. And Scott, you're 100% right. The infrastructure is not there. If I have an EV and I want to drive to Columbus and back, I can't just do it like I can in my gasoline fueled car. I have to stop somewhere along the line and charge my EV up. And I don't know where I would have that right now because there's not a lot of them around. I think I'm not even sure there's any around the east side here somewhere where I live, at least. I know there are some going farther west. So, I'm sorry, Paul, go ahead.
I'm sorry. You also have the problem of just where are you going to get the resources to build these things, the batteries, and there's a lot of mining they have to do to get the lithium and everything for the batteries. That where's that going to come from? I mean, they're stretched to cover what they're producing now. If we keep growing this whole electric vehicle stuff, where's it going to come from? How are they going to build these things and maintain them? And when these batteries start going bad, they're pretty expensive to replace, from my understanding. So, what are you going to do? I don't think anybody. There's a lot that has to be done for this to actually keep going. To where they want to get it with the electric vehicles.
Yeah. So I think we're all positive on the future. There's just a lot of work that's got to be done in the meantime. So this is like a decade kind of play. And when we're looking at the EV stocks, Tesla's sort of the poster child for this, but they're not inexpensive, they're not cheap, because there's been a lot of popularity with these stocks. So, but going on the future, we think it's good. Just be a little cautious right now and plowing into some of these EV stocks. All right, infrastructure spending. Scott, you're right. It kind of does tie a little bit with the EV. It's a broader play. Paul, you mentioned some of the power structure. The House passed $1 trillion infrastructure bill. We'll see what happens with the Senate, and we'll see what ends up being, but probably be something $1 trillion or more. From our opinion, I think we do need it. We need some kind of infrastructure rebuild in this country. We haven't had one in a long time. And again, it favors those kind of stocks and those kind of industries that we just were talking about in some of the previous slides. The material industry, the energy industry. So that's the areas we're looking for clients to keep investing in, and probably keep overweighting as time goes on also.
The one concern I have about the infrastructure spending is it's real easy to print money and spend spend on materials, but you also need people to come to work and actually do the jobs. And that seems to be an issue we have across the country right now. So how quickly does this get done? How quickly does this money make it out to the economy? And what is the impact of it over the next, it's not a short-term thing. It's not a 1-year thing. It's more like a 5 or 10-year thing.
Right.
Yeah, and I think the infrastructure bill was intended to be, it's going to be doled out, not all at one time. It was a 10-year kind of deal. So we'll see how that goes. Okay, interest rates. How long is the Fed going to wait, guys? Interest rates now are at near zero. They've been talking about trying to normalize them. Actually, Jay Powell tried to do what we consider to be the quote unquote right thing and get rates higher back in 2018. He got excoriated for it, by the administration at the time, as well as Congress. So he backed off and cut rates to near zero again. But how long do you think the Fed waits?
As long as they possibly can.
See, we disagree on this a little bit. I think it's sooner than later. I don't think they can wait till 2023. I think it's, I don't know, spring, early summer of next year, where they don't have a choice because we are talking about double-digit inflation. But we should take a bet on it.
Yeah, and we will off the air here. We'll do it.
Not while recording.
Yeah. So by the way, I would agree with both of you that in this way, that they may be forced to do it at some time. And I think they'll probably wait until they are forced to do it. There's a lot of things that can happen to force them to do it. I'd mentioned before the motivation. What's the motivation here? What's the Fed's and government's motivation on interest rates? Certainly the motivation wouldn't be necessarily to raise it. And you guys both know that legally their mandate is to, with inflation, stable prices, price stability is one of the legal mandates that Congress has given the Fed. So even at this point in time, the fact that they haven't raised rates at this point is sort of violating the mandate that Congress gave them, because I don't think anybody right now today would sit there and say that inflation is not an issue. It is. So if the Fed was really going to Congress's mandate on this, they would have announced at the last meeting last week. They would have said, "Hey, we got to raise rates now." So the fact that they're not doing that, tells me they really don't want to do it, and they may talk the game up. And there's a saying that goes, "Your actions speak so loud, I don't hear what you're saying." So we're very focused on what the Fed's actions are, and not necessarily what they're saying they're going to do. And but Scott. So I'm with Paul on they're going to wait as long as they can. And Scott, you may be right that they're going to be forced at some time here in the future to do it. And that's when they're going to do it. All right, what do we see for the remainder of 2021? Certainly seasonality, which just means the time of the year it is, that favors stocks. Over the last 71 years, this has been a great time of the year for stocks. November, we've had 65% of those months, it's been up. Of those years, November's been up over that 71-year time period. December has even better, 53 up years, 18 down, which is 75% of the time that we've had positive returns. So these are November and December are among the two best. I think December actually is the best month historically in the stock market, for the year. So that's a tailwind for the market to go up for the rest of the year. Just the fact that this tends to be a time of the year when people get a little bit more happy with the holidays coming up. There's Thanksgiving and some of the other holidays in December, of course. This tends to be kind of a happier time of year for people.
The Santa Claus rally is a real thing.
Yeah, Santa Claus rally is a real thing. It does. And people they tend to be a little happier, a little friendlier. So there's something about that with the sentiment in the stock market. They feel better about buying stocks. This is something we mentioned, at least 3 or 4 times already in this call. Above average inflation is going to favor those companies that can raise prices. All the same companies that we just mentioned in the energy area, materials area, and staples area. And I think we do agree that the Fed's going to remain hyper accommodative, at least for right now.